Hi. Today I'm going to cover two important documents, or maybe three. The first one I'm going to cover is about Norway's sovereign wealth fund, Norway Government Pension Fund Global. It is the world's biggest sovereign wealth fund, the sovereign oil fund. And again, it gets its revenue from oil and investment returns. And from time to time, the government will extract from it. The big story here is that the Norway Sovereign Wealth Fund, it's mostly allocated to listed equities and has a high allocation to US tech stocks and large European companies. The universal asset owner was contemplating investing in private equity, which generated a ton of interest. That would be game changing for a $1 trillion plus fund. And what I have to the right of me is a report, a recommendation of the Ministry of Finance to the Storting, basically their position. And again, this is an unofficial translation from Norwegian. It's information only. If you are Norwegian or speak the language, you'll probably get a lot more detail. But it basically gives a highlight of what happened during the year and some key deliberations. So, for example, Norway Sovereign Wealth Fund has about a 70 to 72% allocation to equities, meaning that if the global stock market goes up, the fund goes up. If it goes down, it goes down. So it is dependent on those. But that's why you've seen gains for the sovereign wealth fund in recent times, because the markets has been going up. However, that brings a lot of risk. Now, they are an outlier. If you look at other, besides the Government Pension Investment Fund of Japan, which is heavily invested in fixed income and then equities, it is an outlier. You have other sovereign wealth funds and large public pension plans like CPP Investments, Ontario Teachers, the Abu Dhabi Investment Authority, that have allocation to private markets. Right? They are allocated to infrastructure, real estate, private equity, and the like. Norway Sovereign Wealth Fund has avoided this. They've opted for mostly stocks, then bonds, a little bit of real estate, which hasn't done well. They allocated a lot to office real estate, which has done terribly globally, and a sliver to unlisted renewable investments, which no doubt is an impact of policymakers within the country, because those investments, again, haven't fared so well looking at the returns. They're more long-term plays, but it's a very small part of the portfolio. And as I look in this report and go over it, they talk about the generalities of how the funds manage. The objective of the fund is the highest possible return given an acceptable level of risk, which underpins their public expenditure. Also, Norway Sovereign Wealth Fund is known for, and again, it's managed by Norges Bank Investment Management, which is a unit of the central bank. How they exercise ownership rights and have a whole rules on proxies and how they vote. Let's kind of scroll down here and let's look at the investment performance in 2023. Let's see. It says continued high inflation contributed to further policy rate increases in many countries throughout 2023. Yes. Towards the end of the year, inflation slowed down more quickly than expected. As a result, several central banks signaled that policy rates were likely to be lowered during 2024. So far, that has not happened, right? Wall Street was predicting rate cuts in 2024, and they keep revising it to the later part of 2024. Interest rates on international government bonds with a long time to maturity rose throughout much of 2023, but fell back towards the end of the year. The interest rate reduction towards the end of the year contributed to a positive return on bonds. So Norway Sovereign Wealth Fund, they had a lot of bonds that lost money, lost value in the period preceding this, but now those times have changed quite a bit. They also say the global equity market surged over the year despite continued high inflation and policy rate increases. And here they highlight the technology sector generated the highest returns in 2023, largely driven by demand for new artificial intelligence solutions. So basically, every company, if you read their earnings reports, mentioned AI and how they're going to use that and utilize that with their companies, trying to put the keywords in there, right? And the key winners of that race were the tech companies, the tech giants, Google, Apple, Meta Platforms, Amazon, and the companies that make those chips, right? NVIDIA, etc. Let's see what they say. It also reads, let's see. Oh, the Norway Sovereign Wealth Fund received a net transfer from central government in the amount of 711 billion NOK kroner as a result of revenues from petroleum activities being significantly higher than the non-oil budget deficit. So the relatively higher price of oil has benefited the sovereign wealth fund, even though they have a very strong policy on telling oil companies to not to watch their carbon. Okay, let's go down here. They have a bit on responsible investment, right? The mandates from the Ministry of Finance require. Let's see here. Okay. Excuse me, cough. Now, here's something kind of interesting right here. We have something on unlisted equities. Norway's Bank currently has no general permission to invest parts of the GPFG, Government Pension Fund Global, in unlisted equities. Unlisted equity investments were last considered in 2018. At that time, it was decided that the investment universe for the fund should not be expanded to include such investments. Again, in 2022, there was consultative reports. Again, internally within the organization, there has been interest in investing in private markets, especially in private equity. They mentioned institutional investors predominantly access the unlisted equity market via private equity funds, obviously. And MSCI was commissioned by the Ministry of Finance of Norway to estimate the size and composition of the global capital market available to investors. MSCI's analysis shows that the unlisted equity market, measured by assets under management and private equity funds, has grown significantly in recent years. Yes, we all know this. However, it still represents a small share of the global capital market, and it is uncertain whether this growth has been at the expense of listed equities. Okay. And then some professors did some research, and it says basically they indicate that private equity fund investments have achieved a non-negligible excess return net of cost compared to with global listed equity markets. Ouch, ouch, ouch. So basically, if you factor in costs, those returns aren't really there. And keep in mind, public markets are mark to market. I mean, every day there's trading, it's always updated. Private markets get updated on a periodic basis. And they also say it's challenging to measure risk and return for such investments. The analysis are sensitive to the choice of methodology, of course. Interesting. So again, they're kind of hard on private equity funds. Whether you read other board minutes and board meeting notes, they really want to invest in private equity funds. And like many European funds and Australian funds, there's an aversion to high fees, right? Who wants to pay fees? They say private equity funds charge very high fees. Although there may be a high excess return net of cost, high fees may themselves have a negative impact on the legitimacy of the sovereign wealth fund. The current management mandate requires Norway's bank agreements with external managers to include a limit on fees. Good luck. Now, there might be opportunities for discounts if they commit a lot of money to a private equity co-investment vehicle or fund, but again, that will be interesting to see. The ministry assumes Norway's bank will make best efforts to comply with responsible investment, etc. Here's the big news. Given the information currently available to the ministry does not wish to expand the investment universe to generally include unlisted equities. So I'm very sorry for the large PE houses. You'll have to rely on the current lineup and private wealth, which seems to be a very big market for private equity right now. So it's not a rule out. They're still going to talk about it. The ministry intends to ask expert counsel once it's been established to look at transparency. So the ministry will revert to the story with an assessment as to whether the investment universe of the fund should be expanded to generally include unlisted equities when it's completed the review of the issue. So it's going to go on the political level, so it'll be debated on there. So, and there's more information in Norwegian as well. So basically, it's a pause and a no, but it doesn't rule it out. So that's Norway Sovereign Wealth Fund. Very fascinating to see how that wealth fund makes decisions. And again, they, unlike ADIA and the Kuwait Investment Authority, they are just saying, hey, we don't want to invest in private equity funds. All right. Let's jump over to the California Public Employees Retirement System, CalPERS. I like going through this stuff. It is interesting to see one of the largest pension plans in the United States, if not the largest pension plan in the United States, public pension plan. And let's kind of go over this report here. So this is Wilshire Associates is one of their investment consultants, and they've been investment consultant for a very long time. Even when I worked at CalPERS, they were still the consultant, the general investment consultant. So let's kind of look and let's go through some of this stuff. I always found it interesting to read the notes on that they have here. So they have a market dashboard here. It says global 60/40, equities, bonds, month-to-date returns, and then the Wilshire risk parity index, 12% volatility. Okay. Then you have strategic allocation themes: growth, defensive growth, diversified credit, real assets, and defensive. Okay, well, you can see how they did over month-to-date, quarter-to-date. Let's kind of go through here and look at some of the economic highlights that they wrote down here. Real GDP growth spiked recently, equaling 4.9. Again, this is a bit dated because recently we had information that come out. Let's look at the performance here. And wow, you can kind of see the gig sector returns. Energy got hit. And then you see financials kind of come back from the doldrums. And real estate kind of come back from the doldrums month to date. And we can look at the 1-year return on that. And look at IT, information technology. That's the AI craze has definitely been a boon for those investors who have those allocations. Looking at the international markets and economy, non-U.S. equities. Again, emerging markets got hit really bad. And this is why you see a lot of sovereign wealth funds, especially in the Middle East and in other developing economies. They are actively participating in the domestic market. You will see they're also creating vehicles to attract third-party investors to create more liquidity in those markets. So emerging markets have not been doing well. And as you can see, it's getting hit. Well, I mean, you can see U.S. small cap and, well, that's ex-U.S. small cap doing quite well. We can look at fixed income markets as well, 10-year treasuries, right? You have U.S. tips, long-term corporates doing a lot better than before, high yield, right? Scroll down here. Let's look at commodities again. So it kind of just switched in the recent periods, what's doing better or worse. I'm going to go down here. And this is looking at the different, so CalPERS manages a number of plans, right? The big plan is called PERF, Public Employees Retirement Fund. That's the mega, plan within CalPERS. $483 billion as of 2023. 10-year return on that has been 6.5%. And then, the 1 year has been 10.3%, so 6.5%. The actual rate is 7.2%. So the 10-year is not really meeting it, but if you look at the short term, it's better. Then you have these other funds, judges, legislatures, retirement systems, the healthcare fund. Actually, I was at CalPERS when they created that fund. It's still a bit small here. 4, 5, 7 programs. Okay. Now we can get into the actual asset classes. I'm going to blow this up a little bit more because it's kind of hard to see here. So again, you can look at PERF and those returns. And then here are the different asset classes that they have here. So you have public equities, so $215 billion in public equities. Again, a lot less than Norway's sovereign wealth fund, right? Because Norway's sovereign wealth fund has about 72% in listed equities. And as you can look here, it's only about $215 billion from December 31st. So CalPERS is a lot smaller. But again, if you add in all the U.S. public pension plans, that number is huge. But as you can see here, the 10-year return on public stocks is about 7.9%. You have cap-weighted and factor-weighted. And fascinating here is that cap-weighted continues to outperform factor-weighting indices in all these periods. So they might want to rethink the factors that they're using. I know factor-based investing got really popular in 2015, 2016, 2017. That's when a lot of smart beta products came out and either they were passive mandates from the large custodial banks or they try to create their own factor-based strategies within the organization. But it appears those are not doing. That's $58.5 billion versus the cap-weighted indices that outperformed. Looking down at private equity, which CalPERS wants to really get into even more, they've definitely signaled that. not so great. Let's look at the 10-year 11.4. I'm not sure if this is taking costs or not. So 11.4 versus 8.4. The 5-year 11.4, 12.2, 6.1 to 14%. So basically, a little high return there on the 3-year, and then wow, outperforming. So their private equity portfolio, not really a high performing vehicle. And look at the benchmark, the PE benchmark, 22% in the 1 year. So they vastly underperformed the 1 year, and they underperformed barely over slightly overperformed the 10-year benchmark. And we'll take a look at what that benchmark is. Fixed income right here, $130 billion, and again, it breaks out into treasury, mortgage-backed securities, high yield, emerging market sovereigns. Looking at some of the high-performing ones here, investment-grade credit, high yield, looking pretty good there. Real assets, again, they don't break this out. Not doing well. CalPERS had a lot of exposure to office properties, core real estate, which got hit really bad. There's only so much that you can put into data centers and warehouses. This is an area where CalPERS needs to have a lot of improvement. Again, they're a giant, $67.8 billion. Again, they're putting infrastructure in here, I think, to kind of blend the return. I don't know, but again, not doing well. Private credit, obviously doing quite well, 12.2 billion. I think they're probably going to grow that allocation. Then you got some opportunistic stuff here. Again, it's negligible, right? We can go down here and look at total risk contributions. Again, public equity risk, lots of that, and then private equity changes in asset value over the years from 300 billion to now approaching, it touched 500 billion. So it's going up there. I mean, it could be in 10 more years at $1 trillion public pension plan. But what will $1 trillion actually be, right? Just kidding. So you can kind of go here and look at the attribution of each, right? Their returns, and then how much it contributes. So again, how much these areas drive the returns for the fund, cap weighted versus factor weighting right here. Let's go over here. It's more, performance attribution, calendar year to date. And to kind of show you, they had their whole attribution system here. They have the strategic policy, right? That's the contribution of total return. Contribution to total return from each asset class. It's calculated as the percentage allocated to each asset class multiplied by the benchmark return for that asset class. Then there's the actual allocation, active management, and actual return. And here's some notes, again, that they had on each asset class for stocks. Global equities concluded at the last quarter of 2023 in rallying mode following a surge of sentiment in November and December with most major markets. China is being the exception to that, right? Because of the stuff going on within real estate and the U.S.-China relationship, how that continues to deteriorate, causing a lot of Western actors to come back to the West or pursue India. Among major CalPERS asset classes, public equities finished at the top of the leaderboard in the fourth quarter. So again, like Norway Wolf, and that was a major driver. Probably a lot of U.S. tech stocks. Hence, you saw the traditional cap weight indices there. Private equity, we can look at the private equity program results. The underlying purchase reported on a lagged basis, right? Have been constrained and came in at 2.4% in the fourth quarter of 2023. Let's see here. So, not doing well. The real assets is a blend of real estate, infrastructure, and forest, but the majority of it is real estate. And here you can look at some of the portfolios that they have. So they have a global equity index-oriented portfolio, global equity alternative beta, traditional active management, internal factor-weighted index. So that one is underperforming the cap-weighted. I want to read more about it. With the hope of rate cuts to come in 2024, reigniting investor risk appetite, the fourth quarter saw investors rotating out of quality and value. As a result, the factor-weighted equity segment experienced nice overall gains, but the pace was not quite as robust as its cap-weighted counterpart, right? The same held true for the internally managed passive factor weight portfolio, which it earned a low of 8.4%. So basically, yeah, value didn't really pan out because the tech stocks, those are major drivers of returns. Okay, and we've got private equity right here, $68 billion. Go through these. Let's look at real estate because again, we can look at real estate makes up the biggest component if you really look into it. 52.3 billion. Infrastructure is still at 15.2, and look at the returns that you get. Right, infrastructure kind of got hit. Well, actually, it's by quarter 1 year. So the 1 year return is 5.2, forest land 9.5. We got a 10-year on this one, 0.2. Wow. So a lot has recovered since then on their timberland portfolio. 10.6, 6.9. So real estate got really hit pretty bad. Decades high interest rate challenge that can use to pressure the real estate market's assumptions and values. So like I said earlier, the core real estate portfolio deeply impacted, and you'll probably, as these rates remain high, relatively high to what we're used to, right? Because you will also see problems in this portfolio, more problems. And then private debt, still kind of relatively new. And then right here, we're going to all the affiliate funds, which they're much smaller funds. I'm not going to spend much time to go through. Now let's go over another area I want to cover is the actual words spoken, and kind of as they have this transcribed. So as we finish up this call here, let's kind of see if we can highlight anything up that's kind of interesting here, right? There's the interim CIO, right? The last CIO, Nicole, the Canadian, she left, and the interim CIO is Dan Bienvenu. He's an internal person, and we can look at here after the sort of protest minutes. Then they go typically into business onto what's going on within the company or the public pension plan. And here we're talking about ALM review. Now the ALM cycle begins 2021 when the CalPERS board, the current PF, strategic asset allocation. So at many pension plans in the U.S. and elsewhere, they do reviews on different cycles. It could be an annual review, it could be on a 3-year review, 5-year review, 10-year review, depending on what they feel like. And that involves looking at their asset allocation, forecasting returns, changing asset allocation. And then also behind that what are the actuarial assumptions, right? So let's kind of scroll down here. So some surveys here. Okay. This managing investment director, Gunn, has said private equity has provided the highest returns over the preceding 10 years with returns of 11.8%, outperforming public equity by 2.9%. Now, during shorter periods, PE may underperform public equity. Last year, it is an example of that, which is why I think a lot of private equity firms are pivoting towards private wealth management clients right now. You already have the pension market, and they might not get as many commitments as they did in the past. In 2023, public equity outperformed PE by over 13%. Yes. Okay. So we're talking about CMA means capital. First, our long-term CMA projections. Those are capital market assumptions, right? The capital market assumptions alone support the increase to the private equity allocation. Our private equity strategy, with its focus on co-investments and avoiding fees, is expected to add significant value over and above the capital market assumptions. So like I said, all large asset owners, CalPERS, Audia, the ones that invest in private equity, they do co-investments. And the big selling point for investment committees and boards are the co-investment opportunities, a way to get private market exposure at a much lower fee threshold, right? And so that is very popular. The second thing, which he talks about right here, in 2021, we constrain this private equity and private debt allocation to be consistent with our ability to deploy capital. Is the private credit, more money going into private credit? Gunn says we are now recommending the private equity range be 12 to 22%, with a target of 17%. So an increase of 4%. Again, this, I believe this was the March 2024 board minutes. So again, it's about 1 month old here. They think that PERF has the adequate liquidity to support this change. We manage liquidity over multiple horizons from days to decades. That's the thing about pension plans. They're constantly having to pay benefits out, right, while getting contributions coming in. All right. Bring some more here. They want to reduce public equity from 42 to 37%. Interesting. The private debt allocation we're proposing be increased to a range of 3 to 13%, with a target of 8%. That would be increased by a net total of 3%. So private credit is going to be a winner of this. Here's committee member Middleton. All right, thank you very much, Sterling Gunn. Every time and he says, Middleton says, but as we heard this morning in great detail, every time we make a direct investment in private equity, there is frictional costs associated with it in terms of the management and our direct reputational exposure to these investments, right? So what are you investing in CalPERS? Are you investing in senior housing, nursing homes, which again, or investments that don't align with your members or protesters? How are we going to manage the process of making sure that if we expand the amount of private equity that we have, be able to some of the values of this board must have? And then Anton Orlick is one of the managing investment directors at CalPERS. What I would highlight is a transfer of equity risk from the public to private comes with obligation to make sure that the investment partners we engage with uphold our values. And as we heard today, there are absolute circumstances on the public and private equity side. We need to be vigilant to uphold those values. Okay. Oh, he says, I would also flag that we are shifting the proportion of the portfolio away from buyouts. And buyouts are traditionally perform a lot better than venture, which tends to disproportionately have headline risk to CalPERS, moving it towards growth and venture, growth equity and venture capital. Don't forget what the late Joe Deere said about venture capital investing. Okay, you can Google that up in the Wall Street Journal. And any large asset owner that invests a lot in venture capital, you are going to lose a lot of that money. Just say it's a high risk, high reward. Look at the curve. And it's hard to move a lot of money into venture capital. One example that we talk about is the SoftBank Vision Fund, right? You had a lot of Middle Eastern sovereign wealth funds, the public investment fund, Mubadala, invest in the SoftBank Vision Fund. Remember WeWork? Okay. So CalPERS is taking a risk here. They're taking a risk with growth equity in a time where interest rates are a lot higher than they were 3 to 4 years ago. And venture capital, which, okay. Interesting. And how much money can you deploy in growth equity and venture capital right now? That would be a meaningful return for a $500 billion fund. Orlich says, since the current strategy was implemented in the fall of 2022 with the combination of the growth and innovation platform. Innovation platform just means, hey, it doesn't fit in the box, it's very